In this episode, we share several recent updates when it comes to your federal and private student loans, and we break down the difference between something you really need to pay attention to and a news story that seems very scary, but for the time being can be ignored. Let's get started. Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello, my name is Brenton Harrison of Escape Student Loan Debt and your host for the Escape Student Loan Debt podcast. It's been a couple weeks since we had our last episode, and in that episode, we did our first live review of the student loans of one of our community members. I hope that you all enjoyed that episode. And as a reminder, if you want to have your loans considered for a live review, you can go to escapestudentloandebt.com/review, and we will start the process of seeing if it's a fit for the show. In this week's episode, we're going through several recent updates as pertains to your student loans, because in the last 2 weeks, there's been a lot of news stories and updates from the Department of Education as to processing of applications and collections and all this different types of things. And I will say that it's probably 50-50, where some of those things are news stories that you definitely need to pay attention to. And the other half are things that's like, yeah, this could happen, but it's unlikely to happen. And for that reason, it's definitely not something I would stress out over for the time being. So let's start with some things that are updates that I would pay attention to. And one of them isn't actually directly connected to student loans, but it's something to be aware of. And that is the changing environment when it comes to things like tariffs, when it comes to things like bond and treasury yields and interest rates in the general economy. If you pay attention to any of the socio-political stuff that's going on, you've seen stuff about the president pressuring the Fed chair to lower interest rates, and then the yields for 10-year treasuries on the rise. That's not something I expect you to automatically be an economist and know all the things that are going on, but we've shared that when you see interest rate changes in the environment, if you have federal student loans where maybe you're right on the fringe of deciding to actually pay it off or pursue forgiveness, well, the more craziness that goes on with these federal student loans, paying them off in full may look more appealing. Conversely, if you already have private student loans and maybe your student loan is at 8 or 9%, if you were to stumble across an opportunity to refinance it with another lender at 7 or 6%, there's some real opportunity there to lower the cost of total repayment. So we've mentioned on this podcast before that with private student loans, it's a unique structure in the fact that for most lenders, you can at least get an idea of what your rate would be without having to do a hard pull of your credit. So I always encourage people who either already have private student loans or are considering private student loans to set a ticker or a calendar reminder to check the rates at least every quarter, because as all of these fluctuations are going on in the marketplace, if there is a stretch where there's an opportunity that you would miss if you weren't paying attention to, you want to make sure that that's not the case. So more of an alert to keep your eyes open and alert so that if that opportunity comes up, you are there to pounce. Next, let's talk about student loan collections. This is hopefully something that nobody in this audience is dealing with, but having student loans in default is a terrible financial circumstance that can affect everything. So for example, if you have a federal student loan in default, you are unlikely or just won't be approved for a federally backed mortgage. Depending on how much and how long you've been in default, you can actually see your wages garnished as a result of that default. You can have your tax return garnished if you are due to get a refund. In some states, you can even have your professional licenses revoked if you are in default for a federal student loan. But the collection process for defaulted loans has been paused since the pandemic. Well, recently, the Department of Education said that starting May 5th, they're going to resume the collection efforts for those defaulted student loans. Now, unfortunately, there was a program during the pandemic that has since expired where you could get out of default very easily. But now that we're back to the old rules, I will remind you that if you have never been through a process called rehabilitation, that is an option for you. Rehabilitation is a 9 to 10 month period where you can follow a series of rules, one of them being that you have to make a certain number of payments on an income-driven repayment plan. And once you've been through the rehabilitation process, you have that default removed from your credit report. Now, the late payments remain, but the defaulted status is removed. There's a whole host of benefits to having your student loans out of default. If you have already gone through rehabilitation because you can only do it once, then your options are to pay back the debt, You can also consolidate those student loans into a new loan, which would open you up to more payment plans and other benefits, but it would not remove the defaulted status from your credit report. So we've done an episode on defaulted loans in the past. I will link to that in the show notes, but just know that it's a very serious circumstance. If you have loans in default and you have not had any money collected, that is due to change on May 5th in a couple weeks. Next is another news story. We're kind of alternating things that you need to pay attention to and not worry about. But there was a story in the news about a major change that's coming to the public service loan forgiveness program. And it was talking about, all of these things that the Trump administration wants to do to make it more difficult to qualify for that program. And it primarily impacted two different camps of people. The first camp are physicians, and the current administration does not like the fact that physicians are eligible for public service loan forgiveness. This is something that they've stated publicly. So what they're trying to do is make it more difficult for a physician to qualify based on the rules of the program. They also, on top of that, don't like, as they have shared very publicly, so this is not like a political stance, this is something that they've just announced, that there are nonprofits that offer things like help to immigrants that they do not like, and they do not want someone who is not politically aligned with what they're trying to do working for a nonprofit and able to get public service loan forgiveness. So they are trying to make those nonprofits ineligible for public service loan forgiveness. But the negotiated rulemaking process is something that is a long process, and a whole lot of what goes into the negotiated rulemaking process does not come out of it. So while this is something that technically could possibly occur, this is not something that I would put high on my list of stressors, because I think the likelihood that these things get pushed through is slim to none. Next up, something that you should pay attention to and is good news. The department also announced recently that as of May 10th, they are planning to resume the processing of income-driven repayment plan applications. Now, there are millions of applications that are in the queue, but May 10th is the date the Department of Education is listing as when they will kick that process back up in terms of giving loan servicers the ability to push those applications through. Now, there are several things that come along with this of which you need to be aware. Some of those applications that are in the queue were submitted using the old application that still had the option for the save plan on there. And you need to reach out to your loan servicer to ask them if that application will be honored or whether you need to submit a new application. So that's very important. Another thing that's important is the Department of Education has said that they are soon to release another streamlined application for income-driven repayment. Now, streamlined has not, been like fleshed out in terms of what that means. Are they only going to have the income-based repayment plan on there and then have to be taken back to court to have the other plans added? Don't know necessarily, but I know that just like if you submitted the old application, you need to have some type of confirmation from your servicer that it will be honored or confirmation that you need to resubmit. The same would be true once they come out with the even newer application. If you have one in the queue that hasn't been processed, as annoying as it is to have to wait, you need to take some time out of your day when you just are in the office knocking out grunt work, or have some time in the evening to see if you can get someone to confirm that your application will go through. And then lastly, it's not a long episode today. This is just an update episode. And I can't alternate between like, oh, pay attention to this, don't pay attention with this. I ran out of the stuff to not pay attention to. So pay attention to this one as well. There were a lot of articles recently that had people up in arms if they were married with student loans. And the reason for that is in a recent court filing, the Department of Education was talking about how they're going to calculate the payment plans for people under income-driven repayment plans. And what they said was that a person could file their taxes separately from their spouse, but it would not allow them to exclude their spouse's income from their student loan payment calculation. So we've talked a lot on this podcast about all the different ways that you can lower your student loan payment. And a huge way that you see with people who are married with student loans, but their partner or spouse doesn't have student loans, is they would file their taxes separately so that spouse without student loans would not see their income included in the calculation. Now, we have also shared that that's something that you should only do under the advisement of a tax professional, because Filing separately typically leads to more taxes, in some cases, significantly more taxes, both because of a more unforgiving tax code and for deductions and credits that you aren't eligible for if you've chosen to file married filing separately as compared to married filing jointly. So to hear from the Department of Education that even if you file separately, they're still going to include your spouse's income, that terrified a lot of people out there who are married and in relationships where the partner without student loans makes a significant income. And there are people who had already made the decision to file separately who are saying, well, I already paid more in taxes. And now you're telling me that I'm paying more in taxes and I don't even get the benefit of the student loan savings. Now, this is something that from the second that it came out in that court ruling, there wasn't really anybody in the student loan space who was that worried about it as a professional, because the way that student loan payments are calculated, where that spouse's income can be removed, is written into congressional statute. As we've talked about, there's a big difference between what the Department of Education says can happen and what Congress says can happen in terms of overturning that. So because it's written into congressional statute, it's really just one of those things where as soon as it came out, it's like either they are mistaken or they are trying to overturn statute. And as soon as someone calls them out on it, the court is going to brush them back. Well, it didn't even take that long. It was a mistake. The Department of Education came out and said, hey, we are going to allow you to file married filing separately and exclude your partner's income. What we meant to say was that we are going back to the old rules of how the payment was calculated prior to the changes that were instituted by the Biden administration. So let me explain to you what the old versus the new is so you can have an understanding of some opportunities that exist in these scenarios. You're looking on screen, we're looking at a scenario of a family of four. And you look at that family of four, you have the first partner in the relationship who has $100,000 adjusted gross income. And partner two is the person who actually has student loans and they have a $50,000 adjusted gross income. So you can see why they would consider married filing separately and not have that spouse's income included. As a matter of fact, the first scenario that we're looking at on screen, and this is assuming that they're using either the pay-as-you-earn plan or the new income-based repayment plan. If we file jointly with this couple, they would have a combined adjusted gross income of $150,000. And since there's four people in the household, they would get to subtract 150% of the federal poverty level for a family of four. But at that high adjusted gross income of $150,000, it leads to a student loan payment of $848 a month. Conversely, let's assume that they decide to file married filing separately. And they file married filing separately, the Department of Education has confirmed that that partner who makes $100,000 of adjusted gross income will not be included in the calculation. So all that's left is the adjusted gross income of the partner who makes $50,000. Now, in the Biden administration, they instituted a change that said, what we're going to do is when we calculate your federal poverty level for couples who file separately, we're going to remove the other partner's income, but we're not going to allow you to use that person in terms of a number of people in the household. So if we had a person who has a $50,000 adjusted gross income, in the Biden administration, they would get to subtract 150% of the federal poverty level for a family of three. And it would lead to a student loan payment of $83 a month. Now, that's still a tremendous deal. Remember, if they filed together, they would pay almost $900 a month. And by filing separately, they're paying less than $100 a month. They're paying $83 a month. So that's a huge opportunity. However, it is not as big an opportunity as how it worked before the Biden administration, because before the Biden administration, you were allowed to file separately. And you not only could exclude your partner's income, but you could include them as a member of the household. So if we do that same calculation, $50,000, now we get to subtract 150% of the federal poverty level of a family of four. And instead of paying $83 a month, we pay $15 a month towards these student loans. So imagine if you're someone in this relationship where you're making $150,000 as a couple, but based on your tax filing strategy, you could be pursuing public service loan forgiveness and paying $180 a year towards your student loans and still get credit towards the 10 years that you need for PSLF or the 20 or 25 that you need for income-driven repayment. So while there are a lot of things that are not opportunities anymore, like, for example, using the SAVE plan, being able to go back to the old rules of calculating married filing separately for student loan payments is a potential opportunity for federal student loan borrowers in this scenario. And it's bringing up a lot of strategies that people used to use. So number one, it being more prevalent that people use the strategy in the first place. You also see people who will tell you like really complex strategies that, to be transparent, I'm not really a fan of. So for example, you can have a return that is married filing separately, and you can amend that return after it's filed to married filing jointly. So what some people would do is they would file married filing separately when it was time to recertify their student loan income. And then once their payment was set for the year, they would just amend their return and file married filing jointly, and they would get back those extra tax dollars that they had to pay. Now, that is easier than doing it in the reverse and going from married filing jointly to married filing separately. Because after the return deadline has passed, you can't amend a married filing jointly return to married filing separately. So it's a lot of semantics in terms of the order of doing things and tax strategies. To be transparent, I think that is more complex than the average person should be pursuing. But the point of the matter is there are more opportunities and more potential savings based on this calculation of married filing separately as compared to what was instituted during the Biden administration. So what I would say, in spite of tax complexity, I wouldn't be looking at all those like, oh, I'm gonna file this way, then file that way. But if you're even considering this, I would be on the lookout for a tax professional that could help you with some of these considerations, because it could make a tremendous difference in your student loan payment on a monthly basis. So those were some of the updates that I think were valuable. I really don't know how quick it is. I haven't been looking at the clock, but I know this is more of a rapid fire episode than we always do, but hopefully these things were valuable. We'll be back in 2 weeks with some more student loan information that will help you have that loan balance forgiven, reduced, reorganized, or expedited. I'll see you then. From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.